All right, let's talk about something that can drive every trader absolutely crazy: market reversals. Today, we're going to go way beyond just looking at shapes on a chart. We're going to build a repeatable blueprint for understanding why they happen, and more importantly, how you can trade them with real confidence.
So let me ask you this. How many times have you seen what looks like the perfect reversal? You jump in and then bam, you're stopped out just moments later. Look, the tough pill to swallow here is that many of these moves, they aren't genuine reversals at all. They're actually traps, cleverly engineered by the big players, what we call smart money, to grab liquidity.
But what if I told you these reversals aren't just random chaos? They are engineered. And the best part? The people engineering them leave behind a trail of breadcrumbs. And if you learn how to read that trail, you can actually see the turn coming before it happens. You can turn what feels like market manipulation into your biggest opportunity.
So here's our game plan for building that blueprint. First up, we've got to bust a huge myth about reversals. Then, we're going to layer on our 3 key strategies: spotting the liquidity grab, reading chart patterns, and using confirmation tools. And finally, we'll put it all together into one powerful, unified strategy.
Okay, so first things first, let's debunk the biggest myth out there. You've probably heard it, or maybe even thought it yourself. Wow, this thing has gone up way too high. It has to come down, right? Well, that is probably one of the most dangerous and expensive assumptions you can make in trading. A market can stay overbought or oversold for way longer than you think.
And this right here is the fundamental difference in mindset. Guesswork trading is emotional. It's just reacting to price based on a feeling. Blueprint trading, on the other hand, is all about reading the story that's happening behind the price action. It's the difference between blindly chasing a breakout and strategically figuring out exactly where those traps are being set.
This leads us right into our first and honestly our most powerful clue, the liquidity grab. I want you to think of this as the actual footprint the smart money leaves behind in the market. It is the very first signal that a reversal is being engineered. And trust me, understanding this is a total game changer.
So what exactly is a liquidity grab? Well, in simple terms, it's when price pushes just past a super obvious support or resistance level. Why? To trigger all the breakout orders and hit all the stop losses that are sitting right there, like a pool of cash. Then, just as everyone is piling in, thinking it's a breakout, it snaps back violently in the other direction. It's the market grabbing fuel right before it turns. So let's walk through exactly how this plays out, step by step. First, you have the bait, that quick spike through a key level. This springs the trap, hitting all those stops and sucking in the breakout traders. Once all that fuel, that liquidity is gone, the move runs out of steam. It's exhausted. And that's when you see the flip, a super sharp reversal that often kicks off a whole new trend.
So, what does this actually look like on your chart? You're looking for that initial pierce of a key level, usually with a long, sharp wick. It's often followed by an immediate rejection, a big bar that closes back inside the level. But here's the kicker. You need to see a strong, impulsive move in the opposite direction right after. That final push is your big confirmation that the trap has been sprung.
Okay, so once you've spotted a potential liquidity grab, chart patterns are your next layer of evidence. They give you powerful visual confirmation that the momentum is dying. Now, these patterns aren't just magic shapes on a screen. They're the next chapter in the story, revealing the shifting psychology of the market. Let's start with the classic head and shoulders. It tells a really simple story about a battle. First, the buyers make a push. That's the left shoulder. Then they gather steam and push even higher. That's the head. But on the third attempt, the right shoulder, they just don't have the juice to make a new high. It's a crystal clear sign that the buyers are exhausted.
Now here's a pro tip to make this pattern 10 times more powerful. A head and shoulders that forms right up against a major resistance zone from a higher time frame, that's an A+ setup. Because now you're not just trading a shape, you're trading that shape inside a critical fortress of resistance. Context is everything.
Next up, we have the double top. Think of it like this. Price smacks into a ceiling and gets knocked down. It gathers its strength, tries again for a second time, and bam, it gets rejected at the exact same spot. This is such a powerful signal because it tells you sellers are actively defending that price level. They're drawing a line in the sand.
And finally, the simple trendline break. I want you to think of a trend line as the market's heartbeat. In a healthy uptrend, you have that steady beat, higher low, higher low, higher low. When that rhythm is suddenly broken, it's a huge clue. It tells you the underlying structure of the trend itself is changing, and a reversal might be just around the corner.
Now the real key here is a word you need to remember: confluence. It's just a fancy way of saying multiple clues are all pointing to the same conclusion. So when you see a head and shoulders pattern that also breaks a key trend line at the same time, oh man, that is a bright green light from the market telling you it's getting ready to turn.
All right, we have our structural clue, the liquidity grab, and our visual pattern. Now it's time to add our final layer of evidence, confirmation tools. And I want to be really clear here. These indicators aren't a crystal ball to predict the future. Their job is to add a layer of precision and confirm that momentum has in fact already shifted.
Let's take the stochastic oscillator. It's a simple three-step dance. Step 1, price slams into that key resistance level we identified. Step 2, the stochastic indicator starts screaming overbought, showing potential weakness. But, and this is so important, you don't do anything yet. The real signal, the confirmation, is step 3. You wait for the stochastic line to actually cross back down. That's your proof that sellers are taking control.
Another one of my favorite confirmation tools is the EMA Crossover, specifically using the 10 and 20 period moving averages. Again, this is not an entry signal by itself. The best way to think about it is like a visual filter for your chart that cuts through all the noise and clearly highlights when a real shift in momentum has happened.
The process is super simple but incredibly powerful. You identify your key level, you wait for the price to get there, and then all you're doing is waiting for that faster, short-term momentum line, the 10 EMA, to cross below the slower one. When that crossover happens right at your key level, it is a high-confidence confirmation that the bears have taken over.
Okay, now it is time to put it all together. This is where it all clicks. These are not 3 separate strategies to pick and choose from. No. They are layers that you stack on top of each other to build one incredibly powerful, high-probability super setup. It all begins with the story, right? Clue number 1, the liquidity grab at a key level. That's your opening scene. This is the smart money footprint that tells you, hey, pay attention, a reversal might be getting engineered right here. Then you add clue number 2 on top of that. A classic chart pattern, like a double top or a head and shoulders, forms right after the grab. This is the plot twist in our story. It visually confirms that the initial breakout momentum has failed and is now fading away. And here it is, the complete super setup in all its glory. You have the structural shift caused by the liquidity grab. You have the story of fading momentum told by the chart pattern. And you have your final confirmation from an indicator, like an EMA cross. When all 3 of those things align, you have a high probability trade with a clear entry, a defined stop, and fantastic risk to reward potential.
So, I'll leave you with this. Trading reversals doesn't have to feel like you're gambling or guessing. When you learn to combine structure, patterns, and confirmation, you're not just guessing anymore. You're reading the story that the market is writing for you, page by page. The only question is, are you going to keep guessing? Or are you going to start reading the story?